Go to economics chapter 29, investment. When we talk about investment, it means you are adding more capital goods to the economy. So investment is simply purchasing capital equipment or yeah, capital equipment. So here I wrote investment is the addition to the capital stocks of the economy. For an economist, investment only takes place if real products are created. So for economists, they don't talk about investment when you buy shares or you save money into the bank. To you, you think yeah you are investing. As soon as the money is saved in the bank, there you start planning on what to do with the money. But to economists, that is not what investment is for them. For investment for them is something that has been created with the use of equipment or machine.
Physical goods.
Yeah, physically. But sometimes investment could be capital, could be human capital too. But we'll get there anyway.
Like for example, a bank buys an ATM.
A bank having an ATM machine there. ATM machine there, the machine that dispenses cash is an equipment. So which is investment in the capital good. So but before the machine will be before the machine is being installed, it would have meant that the bank has been in place. Customers start saving money and they need to withdraw their money. So the bank feel okay, let's find an easier way for us to allow them to withdraw their cash without even coming to the bank in all. So that is investment. So in the perspective of an economist, saving isn't the same as investment. For example, putting money in the bank account, that is saving. But if the bank is able to buy a computer to manage your account, that is investment. So that's the difference between investment and saving. Do you get the point there?
Yes.
Another point here is about buying shares in a new company. When you buy shares in a new company, it is a saving. If the company buys equipment to carry on its output or to increase its output, that is investment. So I think you understand the difference between investment and saving. But when we look at saving and investment, they simply have something in common, because it simply means we want interest. That means we want interest for the future, and that is what capital will give us. Do you understand what I'm saying?
Yes.
The reward for capital is interest. The reward for saving is interest. The reward on investment is also interest. Did you get the point there?
Yes.
Great. So that takes us to different kinds of investments. So we have the gross investment and net investment. Gross investment is that amount of money you've invested into the business without depreciation. So gross investment measures investment before the depreciation. Equipment, they are bound to wear and tear. So that is what depreciation is about. So before you calculate your depreciation, if you have not calculated your depreciation, you are still talking about gross investment, which means that amount of money you have spent to make that equipment available. That is gross. But when it comes to net investment simply means the capital has been consumed. It has started wearing and tearing. So you have taken away the value of the wear and tear. That means the value of depreciation away from the cost of investment. That is net investment. Do you understand the difference between gross investment and net investment?
Yes, sir.
For gross investment, it measures investment before depreciation. And net investment is investment minus depreciation. Clear, right?
Yes.
Another way to measure investment is through physical and human. So we have physical capital and human capital. So for investment in physical good, I wrote this implies to investment in resources used for production, like equipment, machinery, factories. These are investment in physical goods or physical capital. I think it's clear. And for investment in human capital, this is through training and education, because training improves the value added by human. So when firms invest in education and training for their workers, that is investment in human capital. Is it clear?
Yes.
Any question about investment in physical and human? Great. So what are the factors that affect the level of investment? So we start with the first one, which is the rate of interest. For the rate of interest, we can talk about the first one, which is investment that is being financed by borrowing. So if investment is being financed by borrowing, so it means it is linked to the interest rate. Do you get the point I'm making here? So the availability of if the rate of interest is high, it will affect investment. If the rate of interest is low, it will also have impact on investment. So that is investment that is financed through borrowing. So here I goes. Investment financed by borrowing. A. A rise in interest rate, this reduces the profit made by firms which borrow for investment. The lower the interest rate, the more investment projects will be profitable, therefore increasing investment. So if for firms that borrow, that have to finance their investment through borrowing, so they have to put into consideration the rate of interest. So if the rate of interest is high, it means the profit that will be, because if the rate of interest is high, it will increase the cost of production for firms because their expenses would increase in terms of interest they have to pay. Okay, therefore, the availability of fund for investment would reduce. So firms would not want to borrow to invest when where the interest rate is high. So a lower interest rate means investments through borrowing would be more profitable. So firms would rather spend more on investment then. So a high rate of interest rate would reduce investments through borrowing, and the low interest rate would increase investments on borrowing. Do you get the point there?
Yes.
Any question about that?
No.
Good. So the other one is, we're still on the rate of interest. The other one is investment financed by retained profit. When we talk about retained profit comes from the profit that is not distributed to owners of the business, yes or no?
Yes.
So if we are not distributing this profit to the owners of the business, it might have meant that we can as well keep it into the bank. So if the rate of interest is high, firms would rather save than spend it on investment. So I wrote, investment financed by retained profit. Retained profit is the saving that is not distributed to owners. The higher the interest rate offered by financial institutions, the more attractive it is for firms to save money rather than invest on capital goods or physical goods. So the lower the rate of interest, the greater the incentive for firms to use their savings to buy investment goods. So if the rate of interest is low, so it means there's no point saving. We would rather spend those money than we would rather spend those money for investment than saving because there's no incentive to save. So that's the rate of interest when it comes to borrowing and retained profit. For borrowing, if the interest rate is high, borrowing would reduce. For investment, then, because firms will not be able to make profit. And if the interest rate is low, firms will borrow more because profitability is going to increase for them to borrow. So investment will increase if the rate of interest is low. And for retained profit, if the rate of interest is high, firms will rather save than borrow, than spend on investment. But if the interest rate is low, firms will rather spend on investment in capital goods than saving. I think it's clear. Any question about that? So that's the first factor. Then we go to the second one, which is the rate of economic growth. Are you there, please?
Yeah.
Okay. So another factor is the rate of economic growth. And when we talk about economic growth, we're talking about output within the economy. So the rate of economic growth is linked to what we call accelerator theory. For the accelerator theory, it simply talks about how investment is being linked to output. Investment has to be linked with what? Output. Well, okay. So here I wrote. There's the accelerator theory, which states that investment is linked to changes in the output. This can be explained further as one, an economy that produces the same product. So we want to talk about how economy evolve over time. Sometimes the economy will be constant, fixed. That means they produce the same level of output with the same amount of equipment. So here I go. So this can be explained further as one, an economy that produces the same products and the same amount year in, year out. So firms in such economy will invest to replace physical capital such as machines due to depreciation, but there will be no need to invest beyond the replacement level. So if the economy is producing the same level of output with the same amount of equipment, the only thing that's going to change in terms of investment is for them to replace the capital goods they use, because it's going to wear and tear. They don't have to invest in new equipment because there's no point in investing in new equipment, based on the fact that they still produce the same units of output for the same product. Do you get the point I'm making here? So we're talking about what happens within the economy. If the economy is fixed, it means they produce the same product with the same amount of output or with the same amount of production. So that means the same equipment is being used for the same level of output. At that point in time, that economy does not need to invest more. Firms in that economy do not need to invest more in capital goods. The only thing they have to invest on is to replace those equipment they are using that would have wear and tear because of depreciation. Do you understand the first level?
Yeah.
The second stage is if the economy is expanding. That's B. If the economy is expanding, firms will need to increase their investment to have capital equipment to produce more goods and services. But if the economy is growing rapidly, it would have meant that the equipment available or the investment available in capital goods or physical goods might not be enough. So they might have to invest. So firms in that economy might have to invest more in capital goods. So investment might increase as a result of that.
Okay.
That's the second situation. Then we have the last situation, which is a decline, a negative economic growth. So if the economy is shrinking in size, this could be as a result of recession. With recession, that it is not expected of firms to sell more. So I wrote, if the economy is shrinking in size, as in a recession, firms will not need to replace all their investment goods that have depreciated. With lower output, they will need less capital equipment. Therefore, investment will fall when the economy has a negative economic growth. Because the economy is in decline, based on the fact that there is recession. We don't even have to replace those equipment that are wearing and tearing, that are depreciated, because there's no point in replacing them. Revenue is not increasing, so why do we have to increase investment? So during recession, investment in capital goods would reduce. Is it clear? But during a boom, investment in capital goods will increase, because there's an incentive to increase investment at that point in time. So for the accelerator theory, it is I base t equals to A into, open the bracket, y base t minus y base t minus 1. So I base t means investment in time period. A is the capital minus output ratio. I want to talk about output ratio. It simply means output divided by input. Then this is the formula. Then we have capital minus output ratio, which I said output ratio is output divided by input. Then we have y base t minus yt minus 1, which is the change in real income during the year t. So we're going to have the given year. We're going to have the value of output. We're going to have the value of input. We're going to have the capital included and the amount of investment. Is it clear? Mm-hmm. So the third factor that could influence investment is costs. So here I wrote for cost. Cost. The private sector firms need to make a profit. Firms will therefore invest more if they figure out that cost over the lifetime of an investment will reduce. This will increase profitability. So cost is another factor that decides or determines investment. If firms find out that investing in certain physical good or physical equipment or physical equipment would reduce their cost in the long period, over a long period of time, they would invest more. But if they find out or figure out that investing in certain capital goods will increase their cost, they would not invest. I think cost is clear.
No.
Any question about cost?
No.
Good. The next one is business expectations and confidence. For business expectation and confidence, I wrote, if firms expect their sales to increase, they are more likely to invest in new capital equipment. When the economy is growing rapidly, investment is likely to rise anyway. But if firms lose confidence and expect sales to fall in the future, they are likely to reduce their plan on investment. So business expectation and confidence is simply what happens in the future. If firms believe that sales is going to increase in the future, they will invest more now to meet up with that increasing expected sales. But if they figure out that, or they lose confidence about the future, they will cut their plan on investment. I think business expectation and confidence is clear.
Yeah.
Any question about that? So the next one is the world economy. So when I talk about the world economy, I wrote, if the world economy is growing rapidly, demand for exports is likely to increase. This in turn should lead to a rise in domestic investment. However, a worldwide recession would reduce the demand for exports. Exporting firms are likely to reduce their investment as a result. So the world economy simply means what is happening within the world. If the world economy is increasing, is growing rapidly, it means demand within the world will increase. Export would increase. So exporting firms would rather increase their investment. These are domestic firms. They will increase their investment because demand for their goods will increase. But if the world economy is in recession, the aggregate demand would fall. Demand for export would fall. Exporting firms would not have any other option or choice than to reduce their investment. Is it clear?
Yes.
Any question about that?
Yeah.
Good. The next one is availability of credit. For availability of credit, I wrote, some investment is financed through borrowing. So the amount of money that is available for borrowing within the financial system will determine the level of investment through borrowing. So the more banks consider firms as too risky, the less the money available to them, therefore impacting on the level of investment. So availability of credit comes from, credit facilitation comes from the financial institutions. So if financial institutions figure out that firms are high risk of a customer, they would not give them loans, which means investment through borrowing would reduce. But if firms figure out that if banks figure out that, or financial institutions figure out that banks are low risk as of a customer, they would make credit available to them, then investment would increase. So if credit facilitation is increasing, investment would increase. If credit facilitation is reducing, investment would reduce. Is it clear?
Yes, sir.
Any question about that?
No, sir.
The next one is retained profit. For retained profit, I wrote, it helps to determine the level of investment. If retained profit is low, firms won't be willing to invest as they don't have assurance that the new investment will generate more profit than the previous. So mostly, since corporate tax has to be paid from profit, it can logically be said that a lower tax rate may increase the profit available to firms, allowing more retained profit to be used for investments. So the point is this: for retained profit, it determines the amount of money available for firms to use for investment. So if firms figure out that the retained profit is low, they would not have that confidence to invest that retained profit into capital goods, because they are not assured what happens in the future. So if they are making if they have a low retained profit now, why do they have to risk it again to invest in capital goods? They don't have assurance, so they might not want to invest. But then we have to think about retained profit, which comes after taxes has been reduced. If after taxes have been paid. So if there's a low tax rate, then the retained profit will be higher. Then firms might be willing to invest more in capital goods. So a cut in tax rate, especially corporation tax, might increase investment. Is it clear?
Yes.
The next one, which is the last one, is the influence of governments and regulations. Government can use what we call fiscal policy. And when we talk about fiscal policy, we're talking about expansionary fiscal policy, which is taxes, reducing taxes and increasing subsidy. This might increase investment. So if government wants to increase investment within the economy, government might increase its spending, which allows firms to have a reduced cost of production. Or government might cut taxes, corporate taxes. If government is able to cut corporate taxes, firms will be able to their cost of production would fall. They might invest more. That is fiscal policy. I think it's clear.
Yes.
Then we have regulations. So another way government can encourage investment is through guaranteeing loans. And when we talk about guaranteeing loans, it means government stands for firms that wants to borrow money from the bank. So in case the firms are unable to pay back, government will pay back. So we call it guaranteeing loans. So government stands as the guarantor for firms that wants to borrow money from the bank. So if banks are unable to retrieve their money from the firms, government will pay back. That's another way investment can increase. Do you get it?
Yes.
And sometimes government also use tax relief. Government allows firms to invest and they ensure that whatever tax they want to pay, it has to be offset from the investment.
Mm-hmm.
Clear?
Yes.
And for regulations, government can also use regulations. Regulations can directly prevent firms from investment. So this means, regulations can also directly prevent a firm from investing in a project because it is not permitted by regulations. So if regulations might not permit firms to invest, and if government wants to encourage investment, government might use deregulation. That means government soften laws, regulations that stop firms, that encourages firms. So if a country has a tough regulation, it might discourage investors, and that reduces investment. That ends investment. Any question about it?
Mm-hmm.
Thank you.